Hello and welcome to my channel. This video is a part of NISM Mutual Funds tutorial. I'll be covering chapter number 7, that is Net Asset Value, Total Expense Ratio and Pricing of Units. I've already covered chapter 1 to 6 of this NISM playlist. So I'll request you to watch those videos. You can get the link to that video in the description box at the end of this video as well as on the I button. So I do go and watch those videos. You'll be able to clear your exam with good scores and it will surely help you. Also, do not forget to watch the MCQs at the end of each chapter to get a practical understanding. Whatever questions in multiple types will be coming to you. If you like the video, do hit the like button and please do not forget to subscribe to my channel. That would be really appreciating for my efforts. So now let's start with this one. Valuation of mutual fund. Valuation of mutual fund. A mutual fund scheme invests the investor's money in a portfolio of securities like equity, debt, money market instruments, debentures, real estates, etc. So first let me explain you the meaning of valuation. Valuation is the whole process of deriving the value of mutual fund scheme. Okay, so whenever you are making investment in any particular mutual fund scheme, you must have seen that the units that are allotted to you, it is at a particular NAV that is referred as net asset value. Now that net asset value represents the market price or the current price of that particular mutual fund scheme, which is available for the investors. Now, what happens that the whole process that we are following to derive that NAV, to derive the net asset value or the market price of that mutual fund, that whole process is referred as valuation process. Now, this line is indicating that whenever we are investing in a mutual fund, we must know that it consists of a portfolio of securities. So why does valuation become important? Mutual fund is not a single financial asset class. Mutual fund is rather a way to invest in different financial asset classes. So there are different financial asset classes like equity, debt instruments, money market instruments, debentures, real estates, etc. Now we know that mutual fund schemes have a portfolio of securities. In this video, I would be taking example of SBI Blue Chip Fund, which would be in the upcoming slide. I would show you how in that particular scheme there are so many other companies, there are different types of holding in which it invests. So whenever we as an investor, we are investing in a particular mutual fund scheme, the fund managers who are managing that particular scheme, they invest in portfolio of securities. Now that portfolio of securities can be different depending upon the mutual fund type, the investment objective, and the whatever the financial goal has to be achieved. So we know that there are different types of mutual fund like equity fund, debt fund. There are certain funds that invest in only particular sector, which is referred as sector fund. Then there are different funds investing in short-term bonds, ultra short-term bonds, etc. So there are different types of mutual fund scheme consisting of different portfolio of securities, which later on we would be referring this with an example in the upcoming slide. It would become very clear to you. For now, just know that valuation is the process of deriving the market value of the mutual fund. So whenever you are investing in any particular mutual fund scheme, the units that are allotted to you as an investor, whenever you make a purchase, whenever you buy that mutual fund by investing your amount, the units that are allotted, that is at a particular price, which is known as net asset value, or which is in simpler terms we can refer as the market value of that particular mutual fund scheme. Now the process of deriving that net asset value is valuation. The NAV of the scheme will depend upon the value of this portfolio, which in turn depends upon the value of securities held in it. So you need to note this point, that why does valuation of mutual fund become so important? Because as we have referred in the first sentence, that mutual fund invests in different securities. It can be shares of different companies, it can be bonds, it can be debt debt instruments, it can be money market, real estate, and so many other holdings that is there in one particular scheme. Now, when we need to derive the value of a particular mutual fund scheme, we must first derive the value of all the holdings in which the mutual fund scheme has invested. So whatever holdings, wherever it has invested, a particular scheme has invested, the whole portfolio consisting of different financial assets, different financial securities, they must be trading at different prices in the market. So, for example, if there is one particular mutual fund scheme, as I mentioned, the SBI Blue Chip Fund. So, when you would go through the portfolio of the securities that the SBI Blue Chip Fund invest in, so there are securities like SDFC Bank, they invest in ICICI Bank, L&T financial companies. So the share prices of those holdings, the share prices of those holdings in the trading on the exchange, that are different, that are fluctuating. Now that need to be calculated at market price, and after all the portfolio of the securities at the current market value has been derived, then only we can come to the net asset value of a particular mutual fund scheme. So it becomes very important because one particular mutual fund scheme, it invests in portfolio of securities in different financial instruments, and all those financial instruments are trading at different prices in the market. So all those need to be valued in order to value our scheme, in order to derive the net asset value of the mutual fund scheme. The valuation of these securities to determine the net asset value has to be done in accordance with the valuation guidelines laid down by SEBI and AMFI. Now, these have to be following the guidelines laid down by SEBI, because we know that Securities and Exchange Board of India, it is the regulatory authority of capital market. And whenever we are talking about mutual funds, especially the equity mutual fund that invest the major proportion of amount in the equity instruments that comes under the capital market, or even if we talk about the debt instruments, that even that comes under the capital market. So it is all regulated by SEBI, and hence SEBI has to look after the mutual fund as well. Mutual fund is also thus coming under the guidelines, the policy and procedures of the SEBI. Now it has to follow all the guidelines for valuation laid down by SEBI and AMFI. AMFI, we know it is Association of Mutual Fund in India. So these two together, they lay down these guidelines that have to be followed for determining the values of the securities and determining the net asset value of the mutual fund. Now just have a look at this point. NAV is to be calculated up to 4 decimal places in case of index fund, liquid fund and other debt fund, while NAV for equity and balanced fund is to be calculated up to at least 2 decimal places. So I don't know how it is important, but if you want to remember this for your MCQs questions, you just keep this in mind, that whenever we talk about index fund, liquid fund and any other debt fund, the NAV, the net asset value, the price that would be reflected for a particular scheme, it would be up to 4 decimal places. When we talk about the equity and balanced fund, the NAV or the price that would be reflected for that particular scheme, it would be up to 2 decimal places. Now coming to 10 principles of valuation. Now first principle is fair valuation reflecting realizable value of securities. Now this principle indicates that whenever we are taking the valuation part into consideration, whenever we are performing the valuation, the calculation of all the securities that is held in the portfolio, the market value or the current value should be considered. So we know that cost value is different, market value is different. We can't consider the initial cost when we are valuing a particular security that is being traded in the market, because the price is fluctuating every day when buyers and sellers are trading in those securities. So if we have to do a fair valuation, if the mutual fund has to do a fair valuation, they need to consider the market value of the portfolio of securities. They need to consider the current value. Now that would give a fair picture, because there may be a lot of difference in the initial price when the share was listed and the today's price at which that share is trading. There can be a lot of difference. the same initial cost cannot be considered every time for in the future or anywhere. The same initial cost cannot be considered. So we know that NAV is computed daily. The net asset value is derived daily because the securities that is being traded in the market, they are fluctuating on a daily basis. So there are different prices, there are different closing prices that need to be considered while computing the valuation of the mutual fund scheme. Now that would be called a fair valuation. Coming to principle number 2, valuation methodology approved by board of AMC. So AMC, we know that mutual fund companies from where daily operations are handled, that is referred as asset management company or mutual fund companies. Now the board members of this AMC, they need to approve the valuation methodology. We would be looking at an example in the upcoming slide that how this valuation methodology works, how NAV is calculated, and thus the approval has to be taken by the board members of the AMC. Principle number 3 says valuation in accordance with policies and procedures. So whenever a particular security is trying to be valued, a particular mutual fund scheme is trying to be valued, it should be in accordance with policies and procedures. And we also read in the previous slide that the guidelines that are laid down, those are by SEBI and AMFI, the Regulatory Authority, Securities and Exchange Board of India, and AMFI, Association of Mutual Funds in India. So they provide the guidelines. Principle number 4 says periodic review of valuation policies and procedures. So it is not just that once policies and procedures are set and the valuation is being continued with the same, if there is any kind of improvement required, if there is any kind of errors happening, that need to be reviewed periodically. So there can be a fair valuation as the principle number 1 was saying, the ultimate objective of our valuation. Principle number 5 says valuation should seek to address conflict of interest. So it means that whatever valuation is being taken into consideration, that should be for the best interest of the investors. Okay, so they are being provided with a transparent picture on how the value is being calculated and why is it so fair. It is not that the mutual fund companies are making tremendous amount of profits and the investors are not being provided with the right platform to invest their money, because in that case there won't be a smooth flow of a smooth or efficient flow of money in the market, which is very necessary. So valuation should be in a way that there is no conflict of interest. Even the companies, the mutual fund companies, the AMCs or the parties involved, they are satisfied with the whole procedure. They are able to gain what is fair value, and even the investors are being provided with the lot of enormous opportunity to make their investments grow with the time. So it should address, seek to address conflict of interest. Coming to principle number 6, disclosure of valuation policies in SAI document. So we read about this document in our previous chapters, previous videos, that is statement of additional informations. If you haven't gone through those videos, I request you that please go through the playlist and follow a sync method from chapter 1 to chapter 12. I have uploaded all the videos. So whenever you are watching a particular video in between, you won't be getting that sync. Of course, you would understand with the video, but when you properly follow a sequence like going from chapter 1 to 2, 3, 4, you would get a better idea. All the terms that are being used, you would be familiar with this. So we have already talked about this in our previous video about the statement of additional information document, which provides you additional information related to the mutual fund where you are investing. So the trustees involved, the sponsors involved, those things which are not directly affecting your investment, but if you want to know in additional, so that you can be clear about all the things that are being involved in a particular mutual fund. So that is provided in statement of additional information. Now this principle says that disclosure of valuation policies, all the policies that is being followed for the valuation, that need to be disclosed in statement of additional information. So if you want to just go through the valuation policies, this is the document which you can consider. It is available on the websites of the mutual funds, and you can just go through this statement of additional information, and you'll get an idea about the valuation policy being adopted by that particular company. Principle number 7 says AMC shall be responsible for true and fair valuation. So AMC, asset management company or mutual fund company, because it is at the front picture, it is at the front desk connecting with the investors from where the operations are handled and all. So this is the one responsible for true and fair valuation. It needs to look after its responsibility. Principle number 8 says AMC shall have policies and procedures to detect incorrect valuation. So as I mentioned that it's not that valuations are not meant to changes, policies and procedures are not meant to changes. In any time, if there is any kind of error, any incorrection, or if it is detected that policies and procedures are not fair or something is missing or any better method is coming into picture, that can be considered. AMC shall have policies to detect the incorrect valuation and to take action against it quickly. Principle 9, documentation of rationale for valuation shall be maintained and preserved by AMC. So all the documents that is being involved in this whole valuation process, that shall be maintained and preserved by the asset management company. Principle number 10 says AMC shall take into consideration prices of trades of same security or similar security reported at available public platform. So when this valuation process is being done, as I mentioned, there is portfolio of securities whose prices need to be considered, the current or market price. In any case, if the price is not being reflected at any day on the market of a particular security, then similar security can also be considered, and that need to be reported at all available public platforms. Now let's come to computation part, computation of net asset. You might get a question out of this calculation, so just go through it, try to understand it. It would be simpler one, but of course understand the logic so that you would be quickly able to solve in your exam. Coming to unit capital, total number of units bought by investors into value of each unit. So how this unit capital is calculated, this formula is given over here. In this particular slide, we are trying to compute the net asset. Because we want to compute net asset value, we are first looking at this net asset part only. Okay, so how to calculate net asset? So just going one by one through the procedure. So first let us know how unit capital is calculated. What is unit capital? So total number of units bought by investor. Now when we are talking in this way, like total number of units, we can consider one particular mutual fund scheme. Let's consider, for example, any one mutual fund scheme. Now we know that it's not important that only one individual is investing in that particular mutual fund scheme. So there can be large number of investors who are investing in that particular scheme. Now those large number of investors, they have been allotted with the mutual fund units. Now that is being considered over here, total number of units bought by investors in one particular mutual fund scheme. If we want to derive the net asset value of that particular scheme, we would be first calculating the net asset. So total number of units bought by investor multiplied by value of each unit. So when we consider one unit, what is the value of that unit? Because we want to calculate this unit capital. So total number of units bought by investors into value of each unit. So just assume that the total number of units that has been bought by the investor, that the investors have invested their money it is 20 crore units for one particular mutual fund scheme. This example I have taken from your NISM module that has been provided to you, and you'll get the same example over there. In case you want to be able to understand, you can just go through it, you'll get a better idea, but I'm trying my best to make you understand this. So total number of units bought by investor is 20 crore units. Value of each unit is rupees 10 per unit. So this way we can calculate the unit capital. It means for one particular mutual fund scheme, this amount of money has been raised from the investors by allotting them mutual fund units. So 20 crore units into rupees 10 per unit is equal to rupees 200 crore. So this is the unit capital for that particular whatever mutual fund scheme we have been considering to derive the net asset or net asset value. Second step is, see what happens that 200 crore is collected from the investors. Investors have invested their money to buy the units of that particular scheme, and it is amounting to 200 crore. Now what happens when this money come to that particular scheme, come to the fund manager? So out of this 200 crore, 140 crore has been invested in equities. Now those monies that has been raised, of course the profit or return percent is expected by the investor. It is not guaranteed, but the fund managers, they try their best to provide a certain return percentage according to the scheme objective and the tenure of the investment. So just assume that out of this 200 crore that was invested by the investors in a particular mutual fund scheme, 140 crore has been invested in equities and 60 crore has been invested in bank deposit. Okay, now you can just look at this line, return from equity investment, just assuming that it is 10%. So the fund manager has invested 140 crore in equities instrument and 60 crore in bank deposit. So the return that the manager gets from the equity investment is somewhere around 10%. So it would be 10 divided by 100 into 140, which is 14 crore. And when we talk about the interest and dividend income earned, so it is around 8 crore. Just taking this figure, it's not calculated, just assuming that the interest and dividend income earned is 8 crore. So when the fund manager has been putting money in the bank deposit, of course we know when such a large fund is put in bank deposit, fixed deposit or anything, from there also interest income is earned. So this is what is being referred as interest income. And certain times in the equity instruments there are companies that are providing dividends. So dividend income is also there. Combining this interest and dividend income as rupees 8 crore and return from equity investment as 14 crore. Now what is the next step that needs to be done? That our unit capital was 200 crore, and once it has been invested by the fund manager or from the mutual fund, we just for simplicity we can consider if 200 crore was the initial amount, and after investing that 200 crore, 14 crore has been earned as return from equity investment and 8 crore has been earned as interest and dividend income. So this is kind of profit on the investments made. This is kind of profit. So 14 crore and 8 crore is profit. Now this needs to be added in the unit capital. So just simpler logic that we invested 200 crore and we earned the profit of 14 crore and 8 crore. So now we are having 200 plus 14 plus 8. That is the total amount that we are having. So after adding the profit that has been gained. Now there are some expenses also involved that need to be deducted. So when we are talking about a mutual fund scheme, there are scheme expenses involved, like the fund managers are paid with their fees, the agents and the distributors are paid with their commissions. So there are different kind of scheme expenses involved for any particular mutual fund scheme, and that need to be deducted. It is kind of cost. So we are adding the profit and we are deducting what has been our expenses in managing this fund. So scheme expenses paid is 4 crore and expenses payable is 1 crore. 1 crore is additional expenses that need to be paid. Okay, so total expenses we can see it is 4 crore plus 1 crore, that is 4 crore. Now this needs to be deducted. In our unit capital of 200 crore, there has been profit of 14 plus 8 crore that needs to be added, and there has been expenses of 4 and 1 crore, that is 5 crore, which needs to be deducted. Okay, now you can come to the net asset of the scheme. So unit holders fund in the scheme or net asset of scheme is equal to unit capital plus return on equity plus interest plus dividend deducted total expenses minus total expenses to 200 plus 14 plus 8 minus 5, and we will get this value of 217 crore. So this is how net asset is computed. It is very simple, very simple. You just have to put the logic that there is certain amount known as unit capital that has been raised from the investors. Now that certain amount is being invested in which the profit has been earned. That profit need to be added. Any kind of expenses need to be deducted, and after that we derive our net asset of the scheme. Now let's come to computation of net asset value. Net asset value is calculated as net assets divided by number of outstanding units. So we just now computed net asset as rupees 217 crore. When we divide it by 20 crore, that is the number of outstanding units, the net asset value would be rupees 10.85 per unit. So you see, after you computed the net asset, deriving net asset value becomes very easy. So you just have to divide the number of outstanding units, that the units that has been allotted to the investors, that is referred as outstanding units. So net asset divided by number of outstanding units, 217 divided by 20, which is rupees 10.85 per unit. Now this is the net asset value of one unit of one particular mutual fund scheme. This is how it is derived. There can be another formula which is almost same, just so you can find a little difference. Total assets minus liabilities other than to unit holders divided by number of outstanding units. So here net asset has been segregated as total asset minus liabilities other than to unit holders. Now when we are considering this total assets, we have already added all the profit and deducted these scheme expenses. And when we are deducting this liabilities other than to unit holders, it means the value of 1 crore which we were having as expenses payable, the value of 4 crore which was scheme expenses, that has been already deducted from total assets. So the left value, the other expenses or liabilities, that is other than to unit holders, that is 1 crore. So 218 minus 1 crore divided by 20 crore again would give us the same value, which is 10.85 per unit. Now this is a very simpler formula, these two, of computing net asset value. You need to remember that higher the interest, dividend and capital gains earned by the scheme, higher would be the NAV. So when your investment amount that has been invested in different portfolio of securities and all, return has been earned, there has been interest income, there has been dividend income, there has been capital gains, higher would be all these profits and gain, higher would be the NAV. Of course, and that is how the mutual fund investors gain their value. Once the NAV increases, you are at the profit. And if you redeem your money by selling the units, that is the actual profit derived. So you are making profit out of the fluctuations in the NAV. And that NAV is fluctuating because when the interest, dividend and capital gains are increasing, the NAV is also increasing. So anyways, you would like to have a higher NAV, and that is through if the profits and the gains are higher, the NAV would be higher, and so your profit would also be higher if you have made investment in that particular scheme. Higher the appreciation in investment portfolio, higher would be the NAV. Okay, so if there is higher appreciation in the investment portfolio, higher would be the NAV. Same thing. Lower the expenses, higher would be the NAV. So there are two methods which directly impact the NAV. Either our profit is growing or our cost is coming down. Our expenses are coming down. This is how we try to manage maximum earning out of it. So here we were considering that more the profit, more the gain, higher would be the NAV. In the same way, lower the expenses, lower the cost, again higher would be the NAV. So either the cost is being lowered, the expenses is being lowered, higher would be the NAV of the mutual fund, or the profit and the gains is being higher, higher would be the NAV. So these things you need to keep in mind, how NAV is affected. Now let's come to another formula. Again, it is the same but a more segregated version of computing net asset value. So just see, interest income is added, dividend income is added, realized capital gains are added, Valuation gains are added, realized capital losses are deducted, valuation losses are deducted, scheme expenses are deducted. Now, how you can keep this in mind in a very simpler way? All the income and gains are added in the unit capital, all the losses and expenses are deducted from the unit capital. That is how we derive at our net asset and after that net asset value. So it has been just segregated. Interest income, that is by depositing your money in the bank, that is interest income which we earn. Dividend income from the companies, realized capital gains and valuation gains. There is a little difference. Let me explain this to you. Realized capital gain is that once you have invested in a particular financial security, your realized capital gain would be only when you redeem your money, you sell that unit and you get the profit out of that investment. So that would be your realized capital gain after selling that particular investment. Your valuation gain is what you can track on daily basis. So today you invested at a time when the NAV was rupees 10. After that it has grown to NAV of rupees 15. So it is your valuation gain. 5 rupees has been the fluctuation. It has grown by 5 rupees. So that 5 rupees would be your valuation gain. But that's not your realized capital gain. It would be your realized capital gain once you sell that mutual fund units and you redeem the profit of 5. If you are not redeeming, you are just looking at the valuation that is happening, that would be referred as valuation gain. Same concept applies with realized capital losses and valuation losses. Scheme expenses, we already talked about it. So this is how it is done. Just consider this example. Again, this has been taken from your module. So it has given that calculate NAV given the following information. Value of stocks is 150 crore, value of bonds is 67 crore, value of money market instruments is 2.36 crore, dividend earned, dividend accrued but not received, you can consider this, it would be added. Rupees 1.09 crore, interest accrued but not received, rupees 2.68 crore, fees payable is 0.36, number of outstanding units is 1.90 crore. Now just consider over here, this is your dividend income. It has already been earned. It would be received in a future period of time, but it has already been earned. The same applies with interest. It has already been earned, but it would be received in future period of time. So these two would be added and the deduction would be in terms of fees payable as it comes under scheme expenses. So it would be deducted. The whole value would be divided by number of outstanding units, which we the same formula that we have seen in the previous slide, and this value of stocks, bonds and money markets to instruments, they would be forming a part of the unit capital. So let's see how NAV is derived out of this information. Value of stock plus value of bond plus value of money market instruments plus dividend income plus interest income minus fees payable divided by number of outstanding units. So it is simpler, very simpler, and the same concept, 150 plus 67 plus 2.36 plus 1.09 plus 2.68 minus 0.36 divided by 1.90 crore, and this would be giving the value of rupees 117.25. Okay, rupees 117.25, this is actually in crores. So this is again a method how you can calculate the net asset value. You must have observed that the logic is almost same. Profit and gains are being added, losses and expenses are being deducted, and all has been divided by number of outstanding units that has been allotted to the investors. The same logic is being applied everywhere. Now let's come to this mark to market. The process of valuing each security in the investment portfolio of the scheme at its current market value is called mark to market. So we read this in principles of valuation in the first principle that it should be a fair valuation, and I described it as whenever the securities in the portfolio are being valued, the current market price should be taken into consideration, because that would give a fair picture, because that is the current trading price, the current price in the market at which those securities are trading. So this is the whole process of valuing each security at its current market price. This process is called as mark to market. You can just understand with this term also, mark to market, market value, marking to the market value, same concept. NAV captures the movement of the share included in investment portfolio of the scheme and thus presents a meaningful value for investors. Now, I told you that I have taken this example of SBI Blue Chip Fund. If you just go through it, you will get an idea that this particular scheme has given its top 10 holdings. So you can see these shares are there in its holding: SDFC Bank, ICICI Bank, Infosys, HCL, L&T, SDFC again, ITC, Reliance, Shree Cement, Divis, etc. So these are the holdings in the SBI Blue Chip Fund. So as I mentioned that one particular scheme has its whole lot of portfolio of securities. There are other holdings as well, but it has mentioned only the top 10 holdings where the investment is at the highest level. Okay. So now for each of these shares are being traded on the exchange, we know, and there are different share prices that keeps on fluctuating on daily basis. So if the net asset value has to be calculated, there should be this process of mark to market being followed. It means that the value of each share, each security included in the holding need to be calculated at the current price, at the current market value, and after that the net asset value of the scheme can be derived. Now let's come to total expenses in mutual fund scheme, and we know that how expenses reduces the NAV, and we try to minimize the expenses. We try to look after the schemes where the total expense involved is at the minimum. Investment and advisory fees are charged to the scheme by AMC. The details of such fees are fully disclosed in the scheme information document. So there are charges like investment and advisory fees that is charged to the scheme by the AMC. Then there are charges, recurring expenses like marketing and selling expenses, audit fees, custodian fees, agent's commission, trustee fee, insurance premium, etc. So you can consider, I have already covered this in the previous video where I talked about the parties involved in mutual fund. Custodian is there, agents are there, trustees, transfer agencies, auditors, marketing and selling personnel. So all these key persons involved in this whole management of mutual fund, they need to be paid their fees, their commission, etc., which is referred as recurring expenses. Then investment and advisory fee, we already learned about it. Insurance premium is like when investors are investing so much of large amount of money in a particular mutual fund scheme, it becomes again a responsibility. So the insurance is taken for that the whole lot of money that is being invested for that corpus. The insurance is taken and the premium is paid on a regular basis by the mutual fund companies, which is in turn charged as total expense from the investors. AMCs need to prominently disclose on a daily basis the TER, that is total expense ratio of mutual fund, on their website and on the website of AMFI in downloadable format. Now, when you are going to invest in any particular scheme, if you have gone through the website of that AMC or mutual fund company, you must have seen that there would be mentioned the total expenses ratio, the total expense ratio that is involved in that, and you can get an idea what would be the expense that would be charged to you as an investor. Now, there are certain limits set. It was necessary because the mutual fund companies and the parties involved in mutual fund, they can't just do whatever they feel like. They can't just charge whatever they feel like from the investors. So there has been limits set, and this limit cannot be crossed. It has been prescribed. Just see. So for the fund of fund scheme, fund of fund means it is a type of mutual fund that invests in other mutual fund schemes. So let's just see at the total expense ratio limit of it. Investing in liquid schemes, index fund scheme and ETF, the total expense ratio of the scheme shall not exceed 1% of the daily net asset of the scheme. Just remember, 1% of the daily net asset of the scheme. Now, when we talk about investing in equity and equity-oriented scheme, the total expense ratio shall not exceed 2.25% of daily net asset of the scheme. And here we are talking about fund of fund scheme. So fund of fund, as I said, a mutual fund scheme that invests in other funds. So if this particular mutual fund is investing in liquid scheme, index fund, exchange traded fund, then the TER that can be charged is not more than 1%. If it is investing in other equity fund, the TER that can be charged should not be more than 2.25%. If it is investing in scheme other than these equity, liquid, index and ETFs, so the TER that would be charged should not exceed 2% of the daily net asset. Coming to index fund scheme or exchange traded fund, TER of the scheme shall not exceed 1% of daily net asset. And likewise, there has been whole lot of data given in your module. So you can, if you want to, you can just go through. You might get some 1 or 2 questions out of it. So just remember these numeric values. It would help you to just click in your mind whenever you go through it. But what I have covered in this slide is more important. This you can consider for additional information. Dividend and distributable reserve. There is conservative approach to calculating distributable reserve ensures that dividend is paid out of real and realized profits after providing for all possible losses. Now this approach says that whenever dividend is being paid to the investors, first all losses should be considered. Any kind of expected losses in the future that should also be considered. For all kind of possible losses, there shall be reserve made and it shall be considered. And only with the realized profit after all these consideration, if the company decides to pay dividend, that should be paid. So this is a conservative approach which says that all possible losses should be considered, and when it comes to profit, only realizable profit, only the profits that has already been realized, that shall be considered to pay dividend to the investors. All the profits earned based on accrual of income and expenses as detailed above are treated as available for distribution. Valuation gains are ignored, but valuation losses need to be adjusted. So the same concept when we are talking about losses, valuation losses need to be adjusted against profit, but valuation gains are ignored because realized gains, realized profits need to be considered for payment of dividend. But when it comes to losses, all kind of possible losses need to be first kept aside. After that, whatever profit is left, whatever surplus amount is left, that should be considered for paying dividends. That portion of sale price on new units which is attributable to valuation gain is not available as distributable reserve. The trustee shall decide the quantum of dividend and the record date. So it should be with the approval of trustee how much dividend should be paid and the record date should be mentioned. Coming to concept of entry and exit load. So entry load has been banned by SEBI. It has been quite a long time. Whenever you are making investment in mutual fund, there is nothing charged to you. You are free to make investment. There is no entry loads being charged to you as an investor. But when we talk about exit load, it is applicable and it depends on different scheme. What would be the exit load? And it depends on your redemption time period. Just see. While charging exit loads, no distinction will be made among unit holders on the basis of amount of subscription. So this sentence means that whether you as an investor of mutual fund, whether you have invested 500 rupees or you have invested 5 lakh rupees, there would be no difference of exit load being charged to you because exit loads are represented in terms of percentage term. So if you have invested 500 rupees, 1% exit load of that 500. If you have invested 5 lakh rupees, 1% exit load on that 5 lakh. So it would be in percentage term a quite fair way of evaluation. Now let me give you this concept of exit load with an example. So again, the example of SBI Blue Chip Fund, I think it was like this has been taken. So if before 1 year, like if you have invested in that particular mutual fund for 1 year and for 1 year there sorry, let me just rephrase it. So if you have invested in SBI Blue Chip Fund for more than 1 year, you won't be charged any exit load because here the exit load mentioned as 1% in between 0 to 1 year. So if you have redeemed your money, if you have sold the units, if you have redeemed your money by selling the units before 1 year, which was the period that was expected for you to hold your money. So if you have redeemed your money before 1 year, it means 1% of exit load would be charged to you. But if you have redeemed your money after 1 year, there would be no charges. So you can see it is 0%. There would be no charges if you redeem after 1 year. And if you have redeemed before 1 year, 1% of exit load would be charged. Now this was for that particular blue chip fund example. There are different mutual fund schemes which comes with different exit load. So whenever you go to invest in any mutual fund scheme as an investor, you must see what is the exit load over there, and you must consider that you sell your units, you redeem your money only after that exit load, the period involved in the exit load is crossed. You can also see here expense ratio is mentioned, minimum initial purchase, how much you can invest, additional purchase, how much it can done. When you go through any AMC website, any investment you have to make, all these details are well provided. You can just go through once and you can connect all these terms over there.
Use and try attempting all the questions. First, as per the fair valuation principles laid out by SEBI, it is mandatory to disclose the valuation policy in option A, fund fact sheet, option B, statement of additional information, option C, statement of accounts, option D, the fair valuation principles are not to be put in public. And the correct option is option B, statement of additional information. Question 2. What is the maximum total expense ratio chargeable in case of index fund? Option A, 1% of the daily net asset. Option B, 1.5% of daily net asset. Option C, it depends as the TER changes in line with the size of scheme. Option D, any amount that AMC may appropriate. So the correct option is option A, 1% of the daily net asset. Question 3. In case of mutual fund schemes, dividend can be paid only out of A, premium reserve account, B, unit capital, C, distributable surplus generated by scheme, D, mark-to-market profit. And the correct option is option C. Question 4. Mutual funds are allowed to charge differential exit loads based on the amount of investment, state whether true or false. A, true, B, false. And the correct option is B, false. Question 5. SEBI has banned mutual funds to charge entry load to the investor. State whether true or false. Option A, true. Option B, false. And the correct option is option A, true. So thank you for watching. I hope you liked the video. I hope it would be helpful for you. Thanks for all the support. Thank you.